One of the problems with recruiting for investment banking is not the knowledge or skills you acquire, but the access to talk with real investment bankers to put your best foot forward. Our sponsor, WSO Academy, can provide those connections with 60 head mentors who are finance professionals at top firms like Goldman, Centerview, and JP Morgan. Imagine being able to get on the phone within 24 hours with one of the Academy's 1,300 mentors right before a critical interview. Get on the waitlist for WSO Academy today by clicking the link in the show notes or by visiting wallstreetoasis.com/academy. All right. Welcome to Investment Banking Insights. This is the only show dedicated to helping you learn both the technical and the non-technical aspects of the investment banking process. Hello, my name is Alex Mason and I am your host. Thank you for joining me today. We're talking about accounting basics and I really want to go through all of the financial statements, cover just the fundamental basics of what they are and then various components. Last time we talked about the balance sheet, and today I want to talk to you about a very important financial statement called the income statement. So let's go ahead and go to the whiteboard and talk about exactly what this is and what it's comprised of. Okay, so we're going to be talking about the income statement. You'll see this IS for short, income statement. And basically what this is it answers the question for us. After a company has made a bunch of revenue, paid for all of their expenses, what is left over as the profit? So we have this concept of profit, this concept of expenses, and concept of revenue. So just very simply, at the very top, this is called the top line, you'll see revenue. Now, revenue is the amount of money the company has earned by selling some kind of product or service. And you may also see this referred to as sales. So revenue and sales are the exact same thing. But once a company has sold something and earned money from it, they have expenses that are associated with their business in order to actually do that. So we have different types of expenses. Really, a big part of the income statement and understanding it is just understanding the various types of expenses that exist and how they're categorized. So one of the most important things to know in terms of expenses for the income statement is something called COGS, or cost of goods sold. So you have COGS, cost of goods sold. And this is really important to understand because what this means is the cost required to create that product. So if you have a widget factory and you're selling widgets and you're earning revenue from those widgets, your COGS is telling you how much it actually costs to make the widget. And the reason this is important is because it helps us differentiate from other types of expenses. So the cost to create a product is not the only cost that a business has. A company has to pay its people, for example. A company has to literally keep the lights on in the factory or the building. Those are other kinds of expenses. But effectively what we have is your revenue is at the top, COGS comes next, and then we need to look at other expenses. So if we have, I'm just going to put other expenses here because there's so many different categories. But one thing that we can see is something called SG&A, for example. SG&A stands for Selling, General, and Administrative Expenses. It's a very common type of expense category you'll see on an income statement. That's where all the salaries go, or in some cases where like marketing goes, things like that. You may see other categories depending on the type of firm, like research and development costs, that kind of thing. But fundamentally, you have your cost of goods sold. That's what actually went into making the product or service. And then you have all of your other expenses in terms of expenses related to actually running the business. So within just this area, we kind of encapsulate the main drivers operationally of the business. So if you subtract your cost of goods sold from your revenue, you get something called gross profit. If you keep subtracting your other expenses from that as well, you get something called operating profit. And this is also known as EBIT. So EBIT is an acronym that stands for earnings before interest and taxes. Earnings before interest and taxes. Interest and taxes, sorry. Interest and taxes. So what is this telling us? This EBIT number is actually really critical because it's letting us know before the government takes its cut of the profits and before the debt holders get their interest off of the debt that they've loaned the business, how much profit is this business making based purely on its operations? And this is important because sometimes a company is really high performing from an operational perspective, but it looks like it's not making any money because it has a really high tax burden or it may have a really high interest burden as well. So that's why this is important to understand, operating profit. And then of course, in order to get down to the full accounting profit of the business, you need to take out those other expenses I just mentioned. So you could have interest expense, and you could have your taxes, and then fundamentally, you keep subtracting those things out, you get your profit, which is called your net income. Now, from an accounting perspective, net income is the final number. Like this is called the bottom line. So how much did the company make in this period? So an income statement could be for a quarter, so 3 months, or it could be for a year. So it could be for a quarter, it could be for a year, it could be over a certain period of time. A business made a certain amount of revenue, they had a bunch of costs, and then they end up with profit. So fundamentally, that's what the income statement is all about. It's all about recording how did we get from revenue to profit. All right, that's what we got here today on Investment Banking Insights. Next time, we'll be running through the third financial statement, which is really important, called the cash flow statement. So join me for the next one. Until then, have a great day. Bye.